Ever wondered what the absolute safest return you could get on your money is? Or if there's an interest rate out there with truly zero risk? Welcome back to Derivatives and Risk Education. In our previous lessons, we've often mentioned the risk-free rate, especially when we looked at concepts like present value and no arbitrage pricing. But what exactly is this fundamental rate, and where do we actually find it in the real world? That's what we're going to explore in today's lesson. By the end of this video, you'll have a clear understanding the theoretical idea behind the risk-free rate, why it's so crucial in the world of finance, the common benchmarks we use as proxies, and why choosing the right one is so important. In theory, a risk-free rate would be the return you'd get on an investment that has absolutely zero risk of default, meaning the borrower is guaranteed to pay you back in full and on time. Think of it as the purest form of the time value of money. It's the compensation you require simply for delaying the use of your money for a specific period. Now, let's come back to reality. In the practical world of finance, when we talk about the risk-free rate, we're primarily focusing on the absence of credit risk, meaning the risk that the borrower will fail to repay the debt. Primary benchmarks we use as proxies for the risk-free rate are instruments issued by entities with a very low probability of default. First up are government bonds, particularly those issued by governments with high credit ratings, like the US Treasury, UK gilts, or German bunds. These are generally seen as having a very low probability of default, which is why their yields are commonly used as a proxy for the risk-free rate. For instance, US Treasury bonds are backed by the full faith and credit of the US government. You'll notice that government bonds come with different maturities, from very short term, like Treasury bills, with maturities of a few weeks or months, to much longer term, like 10 or 30-year bonds. The yields on these bonds at different maturities create what's known as the yield curve, which we'll be exploring in detail in our next lesson. Another increasingly important proxy is overnight index swaps, or OIS. These are interest rate swaps where the floating leg pays a rate that is linked to a daily overnight reference rate set by central banks. For example, SOFR in the US, SONIA in the UK, or ESTER in the Eurozone. OIS rates are often considered a very clean measure of the market's expectation of future short-term interest rates and are becoming the preferred proxy for the risk-free rate, especially for discounting future cash flows in many financial models. This is because they reflect the cost of very short-term collateralized funding between highly rated financial institutions, making them arguably even less susceptible to credit risk than even government bonds in some contexts. Worth noting that before the global financial crisis and the subsequent reforms of benchmark interest rates, the London Interbank Offered Rate, or LIBOR, was also widely used for discounting and as a general benchmark for interest rates. However, due to issues of manipulation and a decline in the underlying interbank lending activity that it was supposed to represent, LIBOR has been largely discontinued. Financial markets have transitioned to new alternative reference rates in various currencies, such as SOFR in the US, SONIA in the UK, and ESTER in the Eurozone. These new rates, particularly the overnight ones, underpin the OIS rates we've just discussed, further solidifying OIS as a key proxy for the risk-free rate alongside government bonds. Now, a crucial point to remember is that when you're using a risk-free rate proxy, you need to ensure it aligns with two key characteristics of the financial instrument or cash flow you're analyzing: its currency and its maturity. For example, if you're trying to value a derivative that will pay out in US dollars in 1 year, you should be looking at the yield on a 1-year US Treasury bond as your risk-free rate proxy. Using a bond yield from a different country or a different currency, like a 1-year German bond yield, wouldn't be appropriate as it reflects the time value of money in euros, not US dollars. So, in summary, while a truly risk-free rate in an absolute sense, free from all risks, is difficult to find, in practice, when we talk about the risk-free rate in finance, we primarily mean the nominal rate on proxies with negligible credit risk, such as government bond yields and overnight index swap rates. Remember, the key takeaway is to always ensure that the proxy you choose matches the currency and the maturity of the financial instrument or cash flow you are examining. In our next lesson, we're going to take this understanding a step further and explore how we can actually build a yield curve using these risk-free rate proxies. Thanks for watching, and I'll see you in the next video.